Friends, thank you for being here today. What if I told you that right now across Toronto and the GTA, thousands of buyers are receiving phone calls at midnight, not from scammers, not from telemarketers, but from their own lawyers, telling them they have 48 hours to produce cash they don't have or lose everything? What if I told you that the invisible mechanism keeping the Canadian real estate market afloat, the one everyone assumed was solid, has just snapped? We're not talking about a market correction here. We're not talking about a downturn or an adjustment. We're talking about something far more structural, far more immediate, and far more devastating. We're talking about the appraisal trap, and it's vaporizing life savings in real time. Here's the number that should make your blood run cold. New condo sales in the Toronto region have plummeted by over 60% in the first quarter of 2025 compared to the previous year. That's not a dip. That's not a slowdown. That's the lowest sales figure since 1990. But here's what's truly staggering. It's not because people don't want to buy. It's because they literally cannot close. The mathematical reality is this. You signed a contract in 2021 for $800,000. Today, the bank walks into that shiny new condo and says it's worth $600,000. And in that moment, your entire financial future implodes. This is not a possibility we're discussing. This is not speculation. This is a structural fault line that has been widening for 4 years, and now it's splitting open beneath the feet of anyone who thought they were building wealth in pre-construction real estate. What we're witnessing is a singular inevitability, the moment when paper wealth collides with mathematical reality, and reality always wins. Now, before we go further, let me be precise about what's happening, because the scaffolding of this entire market is built on a mechanism most people don't understand. And here's the part they never put in the official reports. The pre-construction condo market in Canada isn't really a real estate market at all. It's a futures contract. You're not buying a home in 2021. You're making a bet that the price in 2025 will be higher than today. You're betting that the edifice will hold. And friends, that bet has catastrophically failed. Let me show you what actually happened. Let's go back to the genesis of this trap, because this didn't start last week. This started in 2020 and 2021 during the era I've called the Great Liquidity Flood. The Bank of Canada dropped interest rates to near zero. Mortgage money became cheaper than it had ever been in Canadian history, and developers, seeing an opportunity, launched hundreds of pre-construction projects simultaneously. The pitch was intoxicating. Put down 20% today, wait 3 years for the building to complete, and by the time you close, your unit will be worth 30% or 40% more. You'd have instant equity. You'd be a genius. But here's the mechanism hiding in plain sight. That entire calculation was built on one assumption: that interest rates would stay low, that credit would stay cheap, and that the appraisal at closing would match or exceed your contract price. Every single one of those assumptions has now evaporated. This is where the countdown quietly began. In 2022, the Bank of Canada started raising rates. By 2023, the overnight rate had gone from 0.25% to 5%. By late 2024, mortgage rates were hovering around 6% to 7%. And here's where everything changes. When interest rates rise, property values fall. It's not a theory, it's math. Higher rates mean higher mortgage payments, which means buyers can afford less house, which means comparable sales drop, which means appraisers, who base their valuations on recent comparable sales, start valuing properties lower. And this part has already begun. By early 2025, buyers who signed contracts in 2021 started receiving their closing notices. They walked into their lawyer's office expecting to finalize the deal they'd been dreaming about for 4 years. and that's when they got the call. That's when the appraisal came back, and that's when they discovered the trap. Let me give you a real-world example that exposes the sector crisis. There's a case, and this is documented, this is real, where a buyer in Leaside purchased a pre-construction unit for $295 million. They put down a deposit of $439,000, 20% of the purchase price as required. They waited patiently through construction delays, through rising rates, through all of it. And then in late 2024, the building was ready. The buyer showed up to close. The bank sent an appraiser, and the appraiser came back with a valuation of $1.6 million. Let that sink in for a moment. A $595,000 shortfall. The buyer had planned to put down $439,000 and finance the rest. But now the bank would only lend 80% of $1.6 million, which is $1.28 million. The buyer needed to come up with the original down payment plus the entire $595,000 gap. They needed over $1 million in cash to close on a property that was now worth $600,000 less than they agreed to pay. And here is where the cascade becomes unstoppable. The buyer looked at the math and made a brutal calculation: lose the $439,000 deposit or lose the deposit plus another $595,000. They walked away. They abandoned nearly $500,000 because it was still cheaper than closing the deal. This is not an isolated incident. This is the pattern that's replicating across the GTA. Appraisal gaps of 10% to 30% below contract prices are now standard, and most middle-class buyers, people who scrape together $100,000 or $150,000 for a deposit by borrowing from family, by maxing out lines of credit, by sacrificing for years, do not have an extra $200,000 sitting in a bank account. They don't have 48 hours to produce that kind of cash. They default immediately. But that's not the real problem, because what I'm about to tell you is the part that actually keeps me up at night. Here's the detail even analysts tend to miss. When a buyer walks away, they think they're just losing their deposit. They think it's painful but final. They think, I lost $100,000, but at least I'm done. They're wrong. Let's cut through the noise here. When you default on a pre-construction contract, the developer doesn't just keep your deposit and wave goodbye. The developer keeps your deposit, resells your unit, probably at a loss in this market, and then sues you personally for the difference. It's called a deficiency judgment. And it's where common sense actually becomes your enemy, because most buyers have no idea this mechanism even exists. Here's what that looks like on the ground. You walk away from your $800,000 condo. The developer keeps your $100,000 deposit, but they can only resell the unit for $600,000 in today's market. That's a $200,000 loss for them. They've already kept your $100,000, but they're still down $100,000. So they sue you. They sue you for the remaining loss, plus their legal fees, plus the carrying costs of the unit sitting empty for 6 months while they tried to resell it. You don't just lose your deposit. You get a court judgment against you for potentially another $150,000 to $200,000. You're not walking away. You're walking into bankruptcy. And this is vanishing in real time. Go right now, pause this video if you need to. Go to any Facebook group where people are trying to sell assignment contracts. These are buyers trying to offload their pre-construction contracts before closing. 6 months ago, people were asking for $50,000 or $100,000 assignment fees, pure profit for taking over someone's contract. Today, they're offering to pay you $50,000 to take the contract off their hands. They're literally paying strangers to assume their legal obligation just to escape the deficiency judgment. For the average household, this means the difference between financial stress and financial obliteration. This is not theoretical, it's observable. The desperation is metastasizing. And here's where the first domino falls. When buyers can't close, that inventory doesn't disappear. It goes right back to the developer. And the developer who built that tower expecting to sell 200 units at an average price of $700,000 suddenly has 50 units returned. They need to resell them, but they can't lower the price too much because they have their own construction loans to service. Those loans have covenants, financial agreements that require the developer to maintain certain sale prices to prove the project is viable. If they drop prices by 20%, they breach those covenants, and the construction lender can call the entire loan. The developer is trapped between buyers who can't pay and lenders who won't budge. Let me be precise. This is the moment small businesses get crushed, except the small business here is the buyer who thought they were investing in their future, and the crusher is a financial system that has run out of exits. But once this shifts, everything above it starts to shake because the developers aren't just sitting on a few unsold units. Across the GTA, there are thousands of pre-construction units scheduled to close in 2025 and 2026. If even 20% of buyers default due to appraisal gaps, we're talking about thousands of units flooding back onto a market that's already oversupplied and underleveraged. We don't have months. This is happening in days. Reports from real estate lawyers confirm that buyers are being given 48 to 72 hours to produce the cash to cover appraisal shortfalls. That's not a negotiation window. That's a trap door. And the data forces one conclusion. The liquidity required to close these deals has evaporated faster than anyone in the industry predicted. But this isn't even the part that scares me, because there's a secret mechanism that some developers are now deploying, a desperate, dangerous band-aid that's going to make this crisis even worse when it inevitably fails. It's called a blanket appraisal. And what I call the big secret of the entire system is that this tool is being used to prevent the crisis from becoming visible today, while ensuring it becomes catastrophic tomorrow. So, what exactly is a blanket appraisal, and why is it the financial equivalent of putting a steel beam across a crumbling foundation? Let me show you what actually happened behind closed doors in late 2024. Developers started panicking. They were watching buyer after buyer walk away from closing because of appraisal gaps. They were staring at hundreds of empty units and construction loans coming due. So they went to the banks, not the mortgage departments, but the commercial lending divisions, and they made a pitch. They said, look, if you appraise every unit individually based on current market comparables, we're going to have a mass default event. Nobody closes, you get nothing. We get nothing. The building sits empty. But what if you gave us a blanket appraisal? What if you agreed to value the entire building at the original contract prices, ignore the current market, and let the deals close? And here's the part nobody expects. Some banks said yes. This is not a conspiracy. It is a stated policy. Several major lenders in Canada have quietly implemented blanket appraisal programs for select developments to prevent a cascade of defaults. On the surface, it sounds like a solution. The buyer doesn't need to come up with the extra $200,000. The deal closes. Everyone moves on. But let's cut through what this actually creates. When you close on a property using a blanket appraisal, you are taking out a mortgage for $800,000 on a property that the open market values at $600,000. On day one, the day you get your keys, you are $200,000 underwater. You don't have equity. You have negative equity. You are trapped. You cannot sell without taking a massive loss. You cannot refinance because no other bank will lend against the inflated value. You are locked into that property for 5, maybe 10 years, hoping and praying that prices eventually recover to justify the debt you're carrying. But once this shifts, everything above it starts to shake because the blanket appraisal doesn't fix the problem. It just transfers the risk from the developer to the buyer and ultimately to the bank. And here is where the crack that becomes an earthquake starts to widen. What happens in 3 years when those buyers need to renew their mortgages? Let me be precise about the timeline. Most Canadian mortgages have 5-year terms. If you close in 2025 using a blanket appraisal, you're locked in until 2030. But in 2030, you have to renew. And when you renew, the new lender or even your existing lender will require a fresh appraisal. And if the market hasn't recovered, if your property is still worth $600,000, but you owe $750,000 after 5 years of payments, the bank can refuse to renew at the same terms. They can demand you pay down the difference. They can force you to sell, and if you sell at a loss, you still owe the bank the shortfall. This was inevitable the moment the blanket appraisal was approved. And this part has already begun. Some early adopters of blanket appraisals from 2022 are now coming up to their first stress test, and they're discovering that their equity hasn't materialized. For pensions, for family wealth, for anyone who thought they were building long-term security through real estate, this is catastrophic. You're not building wealth. You're servicing debt on a depreciating asset. Now, here's where the psychological trap becomes even more vicious. There's a concept I want you to understand, and it's critical. It's called normalcy bias. Human beings are hardwired to believe tomorrow will look like yesterday. When prices went up for 15 years, everyone assumed they'd keep going up. When cheap credit was available for a decade, everyone assumed it would stay available. And even now, with appraisal gaps destroying deals every single day, most buyers still believe this is temporary. They still believe the market will bounce back in 6 months, in a year, in 2 years. They cannot process the idea that the structure itself has fundamentally changed. But here's the part the experts gloss over. The structure has changed, and it's not coming back. Let me show you why. The foundation of the entire pre-construction boom was built on 3 pillars. Pillar 1, low interest rates. Pillar 2, rising property values. Pillar 3, infinite credit availability. All 3 have collapsed. Interest rates have quintupled since 2021. Property values have dropped by 15% to 30% depending on the neighborhood. And credit, the lifeblood of this market, has been strangled. Banks are no longer lending aggressively. Stress tests are tighter. Down payment requirements are higher. The credit lines that families use to cobble together their deposits have been cut or canceled. The simple logic of borrow now, profit later does not apply here anymore. We are facing a convergence. 3 separate fault lines are rupturing simultaneously, and they're all hitting the same market at the same time. Force 1, buyers cannot close because they lack the liquidity to cover appraisal gaps. Force 2, lenders are tightening standards and refusing to finance overvalued properties without blanket appraisals, which only delay the crisis. Force 3, developers are trapped between construction debt that requires high sale prices and a market that will only bear much lower prices. And here's where the domino sequence becomes mathematically unstoppable. When buyers default, inventory returns to developers. When inventory piles up, developers drop prices to move units. When prices drop, it triggers lower appraisals on future closings, which causes more defaults, which creates more inventory, which forces prices even lower. This is what a liquidity death spiral looks like in real time. It's not a crash, it's an unwind. and the unwind has no natural floor until it reaches a price point where cash buyers, investors with no need for financing, step in and absorb the excess. But that's not the part that should terrify you, because what comes next is worse. Let's zoom out for a second and talk about what this means for the developers themselves. A real estate developer is not a billionaire sitting on mountains of cash. A developer is essentially a project manager who borrows money from a bank to build a building, pre-sells units to lock in revenue, and uses that revenue to pay back the construction loan. The entire business model is built on leverage. The developer might only have 10% to 20% of their own equity in the project. The rest is borrowed. Now imagine you're a developer. You borrowed $150 million to build a 200-unit tower. You pre-sold 180 units at an average price of $750,000. That's $135 million in expected revenue. After construction costs and fees, you're expecting to net $15 million in profit and fully repay the bank. But now 40 of those buyers default because of appraisal gaps. You keep their deposits, let's say $4 million total, but you still need to resell those 40 units. In today's market, you can only get $600,000 per unit. That's $24 million instead of $30 million. You just lost $6 million in revenue. Your profit is gone. But worse, you might not have enough to fully repay the construction loan. And here's where everything changes. When a developer cannot repay a construction loan, the bank doesn't just shrug and take a loss. The bank seizes the building. It's called receivership. The developer is removed. The bank takes control of the asset and sells it off, usually at a steep discount, to recover whatever they can. This is a default in all but name. And this is vanishing in real time. We're already seeing the first wave of receiverships in the GTA. Small and mid-sized developers who over-leveraged during the boom years are now being forced into insolvency. Their buildings are being taken over by banks and institutional lenders. And when a bank owns a condo tower, they have one goal: liquidate it as fast as possible. They don't care about protecting the market. They don't care about comparable sales. They care about getting their money back. So they slash prices. They offer units at 20%, 30%, 40% below the original pre-construction prices just to move inventory.